SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures, and this is the SMB Investor Podcast. Today I'm joined by John Bartlett of Brentwood Growth. John is an expert in all things trade contractors and commercial B2B services. So with that, John, I'll let you give a quick intro on yourself and Brentwood, and we'll go from there.
Well, thanks, Sean. Yeah, so my quick story, I'm 68, bought and run and sold a handful of businesses over a 5-year career. I tried to retire 10 years ago and I wasn't very good at it. And having bought businesses and run businesses and sold businesses and using investment banks and selling them to private equity firms, I sort of knew the drill. Being 68, I'm a baby boomer. And I just felt like there was an opportunity to create a boutique advisory business, which is what we did. We started this business 6 years ago. In the beginning, industry agnostic, COVID hit, things began to slow down. As we ground through COVID, I began to hear more and more about essential businesses. I realized that a lot of these essential businesses were blue collar trade businesses. And we decided to niche down and focus specifically in the trades. So the way I define the business today, we're sell-side advisors. We work with service providers and contractors that are in the trades, anyone that's residential, industrial, and commercial focused. There are about 25 different subsectors that we cover: HVAC, plumbing, electrical, roofing, garage door, lawn care, irrigation, or some of the ones that everyone knows. But when you really think about a home, an industrial, a commercial building, I mean, there's a whole nother 25 other sectors that are involved in either servicing the facility inside or outside the building or the infrastructure that's there. And it's things like flooring, it's things like fire and safety, it's things like janitorial, it's things like elevator, escalators, foundation repairs. It's a pretty broad list of sectors that we cover, but they all have similar characteristics. They're providing some service. They're in a local geographical market. They've got a service area that they cover. There might be a construction component. There might be a retro replacement part. There might be a service and maintenance part of the business. The revenue mix can be different from sector to sector and from business to business, but they've got a lot of similar characteristics. Across the 25 trades that we cover, we've got a database of owners that are doing at least 3 million of top line. We've got over 300,000 owners in that database. These guys have a lot of similar characteristics in terms of their business. They're large fragmented sectors. There's a lot of opportunity to buy these businesses and to continue to professionalize these businesses. And then there's a lot of institutional money that has realized that there's an opportunity through a variety of strategies to do some roll-up consolidation, professionalism strategy within these sectors.
Well, it's a great background, and you are in certainly what I think most people would view as the hottest sector, especially in this, micro cap PE world, right? When people talk about what's your ideal target, I think a lot of folks historically have said, oh, it's a residential HVAC contractor, a plumber that focuses on maintenance and repair work, lots of small jobs, no customer concentration, lots of recurring revenue. But the reality is, like you said, there's always that mix of construction, new install revenue, retrofit replacement, maintenance, preventative maintenance. There's always a mix of that. And there's certainly themes across the business models. What are some niches that, you see of the 25 categories that you represent that maybe folks overlook that exhibit those same kind of revenue quality and earnings quality dynamics?
If you go to our website, if you go to the buy section of our website, there's a buyer profile form, and we've got all 25 of the sectors that we cover there. A sector, for example, that is drawing a lot of institutional interest right now is the roofing sector. We started covering the roofing sector about 4 years ago after we had done the HVAC, plumbing, and electrical sector. It's so different, and it's different because the revenue mix is different. dependent upon whether it's a residential roofer or a commercial roofer, dependent upon where they're located geographically in the country. They might be in Florida, or they might be in Texas, or they might be in Kentucky, or they might be in Arkansas, or they might be in Colorado. A lot of times there can be weather related events. There can be a hurricane that comes through, or a tornado that comes through, or a hailstorm that comes through. There are a lot of climate factors that can impact what the business is. The roofing sector has become very interesting right now. I mean, some of the other sectors that I think are overlooked, cleaning and janitorial is an example, particularly on the commercial side. The thing that's interesting about that is there's a lot of recurring revenue there. There can be a lot of maintenance contracts associated, particularly on the commercial and industrial side of that sector. But when you look at the margins, when you look at the recurring nature of the revenue mix, when you look at the ability to grow and scale the business, it's got some fantastic characteristics to it. The fencing sector is one that you would never think of, both on the residential side and on the commercial side. We've spoken to a bunch of fencing guys, and if they have the right business model, both on the commercial and on the residential side, you can see gross margins in that business in the 55 to 60% range. So it's just a fabulous business. The garage door business, there's a lot of interest on the residential side. I think people maybe overlook the commercial side of that business. There's so many industrial buildings out there where they've got large overhead doors, and it might be a freight dock or something. There's just a ton of opportunity in that sector also. Some smaller businesses, pool supply or pool service. It's a small sort of niche business. It's hard to find a big platform that's out there where you've got a business in a geographical market that's doing 5 million top line or 10 million of top line. But there are a lot of small, fragmented, independent operators that are doing 1 million to 2 million, and it's very consistent recurring revenue. There are all sorts of diamonds in the rough that are out there that are not, it's not like HVAC that private equity's been doing roll-up consolidations there for 10 years. There are tons of other sectors that I think have a lot of the same characteristics, much more reasonable multiples, and you've got the same opportunity to professionalize the business, to grow the business, to scale the business. And
Yeah, those are some great examples. And common thread is the local market that those businesses are in, the kind of average home prices or demographics and kind of income ranges, but it's also about the weather and the kind of what is the climate in that market. Would a HVAC or a pool service deal that's not in the Sun Belt, maybe in a B plus market, potentially represent an interesting opportunity because it's overlooked?
Yeah, and that's a great question. Obviously, the Sun Belt, everyone's interested in buying businesses in the Sun Belt, and so there's going to be a lot of competition there. You know, you're not the only one that's come to that conclusion. And so if you're looking to buy a business in those markets, you got to realize that there's a lot of competition there. This is sort of what you're going to run into if you're chasing those popular sectors in these popular markets. The thing that I would look at, though, is, if you have a good business that you're comfortable with the market share they have in their local market, and there's a good brand there, and there's a good management team there. So many of these businesses, the owner founder, he was a trade guy himself, and he didn't want to work for somebody else. So he decided to, buy his own business or start his own business. And then over time, he's figured out how to grow the business to a certain level. But so many of these guys, they've done a wonderful job of getting the business to a certain point and the growth that they've been able to achieve. But when you look at where the business is, when you look at their market share, when you look at the ability to professionalize the business from a marketing standpoint, from a sales standpoint, from a technology infrastructure standpoint, from an operations standpoint, to be able to build a recruiting team and build an onboarding team and build a training team and build the proper culture. There's just so much opportunity to, take this business that's doing 5 to 10 million. But when you when you look at the marketing that can be improved upon, there's a lot of low-hanging fruit there. When you look at what their sales team looks like, there's a way to quickly improve the quality of that. I just think with a lot of these businesses, with the right kind of owner, with the right kind of management team around, I'm not saying it doesn't matter where it's located, because it matters where it's located to some degree. But when you look at these businesses, when you look at the brand that they built in their local market over time, when you look at the ability to professionalize and grow the business, there's so much opportunity there.
Yeah, the frequent themes we consistently hear every deal we look at, there's a element of improving sales and marketing. So that's one. There's an element of growing to a point where there's more of a middle management layer, especially if it's 10 to 15 employees. And like you said, the owner's grown it really as the CEO and potentially even as the head of operations and even on the tools every so often, right, as they say. So those are very consistent themes, is the inorganic growth. And so when you talk about finding a company that has good market share in its local market, which is critical, all these guiding is they have kind of local economies of scale, but there isn't that global economies of scale dynamic. You need that local presence. So if they have that local market share, the concept or the premise is they can be a good platform to bolt on a few more and build depth around that. How many, I guess, if you were to kind of try to quantify it back of the napkin, how many of the folks that you talk with are kind of pursuing that inorganic approach, or are versus just saying, I'm going to buy one business and that's all I want to do?
We sold probably 15 deals last year, and the average enterprise value was around 10 million. I don't think any of the 15 that we sold, as you look at how they built their business, there was any acquisition component to their growth. It was all organic growth. And I sort of developed this concept, and as the org chart grew in size, and as the departments began to form, and as me as the owner needed to change in terms of how I was running the business. And so I came up with this concept that I call the 7 levels of growth. And so I think businesses fall into 7 categories based upon the size of the business, based upon the number of employees, based upon what the revenue is, based upon what the cash flow is, based upon what the multiple is, and based upon what the valuation is. You've got a level 1 business that's doing 500,000 less, and it looks a certain way. You've got a level 2 business that's doing 1 million or less, and it looks a certain way. You got a level 3 business that's doing 2.5 million or less, a level 4 business that's doing 7.5 million or less, a level 5 business that's doing 15 million or less, a level 6 business that's doing less than 50, and a level 7 that's doing more than 50. And so as the businesses go through the progression within these 7 levels, a lot of things change. The revenue changes, the number of employees change, the org chart changes, cash flow changes, tech stack that you're managing the business change. The most important thing that changes as a business goes through these 7 levels is the guy that's running the business as the, CEO, founder, whatever his title is, he needs to change, or she needs to change. And they need to change based upon the way they're viewing the business, the way that they're giving up control of the business, the way that they're allowing departments to be formed, the way they're putting managers in place, the way they're, putting KPIs in place to run the business. All of this needs to change. And so many of these businesses, the business owner, he's an entrepreneur and he's a bit of a maverick and he's a bit of a control freak. And so they sort of hit a ceiling that the business cannot grow beyond what they're willing to give control up. And so it sort of caps out. It caps out. And I think a business can grow organically up to maybe 10 million or so. But then if it's going to push from 10 million beyond that, there's going to be some organic growth in there that's going to drive that growth. But there needs to be some acquisition at that point also to continue to grow. There's only so much market share within a given geographical market you can grab. And so you got to be willing to move into other markets. And a lot of times by buying a smaller business in a different geographical market, it allows you to plant a flag and sort of grow. A lot of these owners are not willing to do that. They're not willing to take that risk. They're not willing to expand the management team, and so the business sort of gets stuck. And I'm not saying stuck is a bad thing. The owner has created a great business that's provided, a great lifestyle for he and for his employees and for his families, but that creates the opportunity for some of your investors that are buying these $10 million businesses and they want to grow them to $20 million business or $30 million businesses. Yeah, there's some organic growth that can help accomplish that, but there's also geographical expansion into neighboring markets that can allow them to accelerate that growth. But then it takes a different skill set. It takes a different type of owner. It takes a different management team. It takes a different balance sheet to be able to uh, buy these companies, to be able to integrate these companies, to be able to, bring different companies with different management teams under the same cultural umbrella. That's a big ask for, a blue collar trade guy that's grown the business over a 30-year period up to $10 million. And all of a sudden you're saying, well, let's build this thing to 50 and let's go buy 4 other companies. And that's going to blow his mind, man. And maybe he's not the right guy to do that. Maybe it's time to bring in a different ownership team and a different management team that's got an expanded skill set that can help the business continue to grow and move through those 7 levels that I'm describing with some expanded balance sheet and some expanded management team that can fuel that.
Yeah, it's almost, and I'm curious your take on if, there's almost like a tipping point where that inorganic growth is either too soon or, we call it premature. So if you say, at the 10 million mark is sort of where you need to have a good mix and potentially the right team to execute on that sort of, bolt-on strategy. But, we see a lot of folks who come to market, they've got a company with $2 million in EBITDA or maybe 3 million in EBITDA under LOI. But
Right.
their strategy is, hey, we're going to go now buy some more, say to 1 million, maybe similar sized companies even, and put them all into a platform. And a lot of the folks we see doing that generally have experience with a similar strategy, just up market. But is there a point where you'd say, if you saw one of those presentations and it said, yeah, we're going to start out with a $2 million EBITDA platform. Is that, premature in your mind?
I think it's premature. I think at 10 million, back of the envelope, at 10 million, you've got roughly 40 employees. And at 40 employees, you've got a marketing team in some capacity that's been formed. You've got a sales team that's been formed. You've got an internal client support ops team. You've got a bookkeeper, maybe a controller. You've got some sort of HR department. You've got a field management team. And so you've got the bones in place at 10 million. Okay. And I think a $10 million business, if it's a tuck in the same geographical market where they can just sort of fold it in to the existing management team that they have, I think dependent upon if they don't get the balance sheet stretched too far and they got the financing capability to structure the deal where they don't get themselves in trouble from a cash flow standpoint. I think if it's in the same geographical market, then that could be done. If you've got an HVAC business, I don't know, in the greater Tampa market, I mean, can you buy another HVAC business that's in Sarasota or within the same sort of metro market and be able to integrate that? Yeah, you could probably do that. If you got an HVAC business in Tampa, could you add a plumbing service division to that's going to service the same client base? Yeah, you could maybe do that. If you're a $10 million company in Tampa and all of a sudden you decide that, you want to go to Orlando or you want to go to Miami and that's a 2 or 3 hour drive. I mean, that's a stretch, man. That's a stretch. It's hard for that management team to be able to absorb that. And so I would be careful at $10 million of overly absorbing what the existing infrastructure and management team is able to absorb in particularly getting stretched too far from a geographical standpoint. I mean,
Yeah, that's always a big question that comes to mind for us. We've seen a handful of strategies where folks may have some really attractive targets in a couple different, or maybe, even more than a couple different geographies, but there's not really that ability to create route density, which is such a
right,
common synergy
right,
that people talk about. Even more concerning is, like you said, you just physically can't be on site at all those
right,
locations at the same
right,
time.
right.
So that's kind of the one that I think has spooked us the most because, especially during the transitionary periods and things of that nature, you just never really know what's going to happen. So
I would stay sector focused. I would maybe drop a couple of complementary sectors into that. And then, I mean, I would almost think about the business growing from an acquisition standpoint in terms of concentric circles that are sort of getting wider and wider as the team and as the company is continuing to evolve. If you've got a $25 million company, I mean, that looks very different from a $10 million company. Maybe the 3-hour plane flight is not quite the challenge at 25 million than it was at 10 million.
sure. All right. Well, very good feedback there. I guess just moving into kind of our last topic here, what tips do you have for folks that are considering, investing passively into some of these strategies, right? So they'll be backing an acquirer as a minority investor on the cap table. What should they be looking out for, whether it's revenue quality, some of the stuff we talked about in respect to the management team or inorganic growth strategies? What would you say are the top 3 things you'd look out for?
Obviously, I'd look at the historical financials to be sure that the operating margins, both on a gross basis and a net basis, are within an acceptable range. So I would start there. Secondly, I would really drill down in terms of what the revenue mix looks like. I would try either to have as much of the business to be service and maintenance oriented as I could when I bought the business, or have a clear path. If there's a heavy construction project nature to it, when I bought the business, have a clear path as to how I'm going to sort of bend the curve over time, and not necessarily reduce what the construction exposure is. Try to diversify what that looks like, but more importantly, try to build out the service and maintenance part of the business where the revenue flow has more of a predictable, consistent, recurring theme to it. And so, I mean, I wouldn't be afraid. It's 80% new construction today. That's a no go. But if there's a way that you can take the construction projects that you're doing today and you can build out a service and maintenance component from those construction projects over time, that might be interesting. I think the third thing, and it's probably the most important thing, is you got to be sure that the operator that you're backing, you've got total confidence in their background and their experience and their vision in terms of what they plan on doing with the business. Just be sure you've got 100% confidence that the management team that you're backing and the operator that you're backing that's going to be running this platform, you've got confidence in their ability to articulate what their vision and strategy is. And they've demonstrated at some point in the past and a historical track record of being able to deliver on that vision. Because at the end of the day, that's really what you're investing in. You're investing in that operator's ability to execute a plan. And so you got to be very confident in that operator's ability to execute on that plan.
Yeah, that's a great point. We think a lot about some, classic value investing. I would say mantra is, or at least in many value investing schools of thought, is you want to, bet primarily on the horse, meaning the business, but you want to have a good jockey riding the horse. I think that works really well when you're talking about a big publicly traded company where there's probably a lot less key person risk. But in this lower market, especially when, like you said, that $10 million range where maybe you got 40 employees or lower than that, that entrepreneur is so critical. And in
Very
many cases, we can see kind of themes emerging in the investments we look at where, in some cases you got a great horse. It's a really nice business and great recurring revenue streams. We're pretty confident in them, consistent margins. Sure, you could probably say, all right, there's a little more room in the type of entrepreneur we'll back on this one. Maybe they have less experience, freshly out of MBA, that sort of thing. But when you see a business, to your point, that maybe has more, uncertainty around revenue, like new construction type projects or things of that nature, we want to see a really strong jockey there. And we almost think of those as jockey type bets.
The most important thing to that point is the operator that you're backing, and this is going to sound weird to say, but their ability to be a leader and to build culture that's going to get buy-in across the organization, that's going to enable the company to be able to recruit and to upgrade what the talent within the organization is, to build a culture where they're not having to deal with back-end churn because people are leaving all the time. Building that culture is so critical. And I think it's so underrated also. It's sort of a forgotten, because if you're not building an environment that people feel appreciated and people feel motivated and people understand clearly what the value system within the company is and exactly what the expectations are. It's like a house made of sticks or something that's going to burn down. So that operator understanding the importance of the value system within the company, the expectations within the company, the culture that he's building that's going to allow him to recruit and to allow him to be able to retain. I mean, that's as touchy-feely as this sounds.
Yeah, and every day I see more and more literature coming out about the importance of culture, right?
100%.
And just there's a lot of folks that talk about culture as a value creation strategy itself, right? And that you frankly you need that to underpin any other strategies you want to pursue. So that's a great point, and a really good one for people to keep an eye on as they're looking at these deals. One more quick bonus question for you, since you're so close to the market for trades. Across the 25 sectors that you represent, how do you see EBITDA multiples ranging, generally speaking? Are there any sectors that have kind of premiums on their multiples, any that are lower? What dynamics might influence that multiple?
I think the size of the business matters. I think the revenue mix matters. I think where the business geographically matters. I think the sector that they're in and the amount of competition there is for that business is all going to matter. The multiple range that a business is going to trade on, it sort of moves in ranges. Going back to the 7 levels, if you've got a business it's got an EBITDA of 500,000, it's going to trade for 3 to 5 times. If it's got an EBITDA of 2 million, it's going to trade for 6 to 8 times. And so they're going to move in bands based upon the size of the business, based upon what the revenue mix is, based upon the sector that it's in, based upon the geographical location. And the sector that it's in is going to determine the amount of competition that's out there looking at that deal also. And that when you run a process and you get a bunch of firms chomping at the bit, that's going to drive that multiple up. And so if you're trying to avoid a lot of the institutional competition and not get into a bidding war where you're having to pay up for this stuff, you got to sort of go where they ain't. And so you got to figure that out. But I do think, generally speaking, these businesses trade in ranges, and where within that multiple range it's going to fall. It depends upon the sector. It depends on the revenue mix. It depends on, is it residential? Is it commercial? It depends on where it's geographically located. And it depends on the competition that's out there to buy that same business.
That's great feedback. Good items to look for and to kind of, benchmark again, is this multiple at the high end of the range, and do all those characteristics you just listed justify that multiple?
Publicly traded security, that's a relatively efficient market. Privately traded companies like this, it's a very inefficient market. And so, you just don't know. You don't know.
Well, folks like you are helping make it more efficient, and that, frankly,
Trying to.
it enables everyone to, make sure that local businesses are staying in operation and creating value for folks like us who are investing in them. So it's a good ecosystem.
Sean, there's so much opportunity out there, man. So much opportunity.
That's for sure. Well, look, anything you want to close out with before we end the call?
I don't think so. If there's anybody out there that would like to talk further and just get our thoughts on the market generally and how we view certain sectors, we'd be more than happy to talk to you. If I were 30 years younger, this is what I would be doing.
Fair enough. Well, great wisdom to be able to pass on to folks. And thanks so much for taking the time, John.
Okay, brother. Good to talk to you.
Likewise.
Later.